Stocks have been up year to date. Macy's and Kohl's up about 30% year to date. So selling into the strength. Also, there is anxiety. We've seen a rotation from growth into safety. In addition, tariffs are a real risk. And across the retail sector, goods sourced from China could compose from 20 to 60%. That's a fear too. And global markets, in terms of emerging markets, fears too. I think these are all bits of the psychology that factor into this. However, the U.S. customer is very strong. The U.S. economy is very strong with low unemployment, high consumer confidence, and wage growth.
Is there enough wage growth to then offset some of the increase in price from tariffs? I mean, we heard Target and Walmart effectively say that they would take care of that cost. It sounds like they would some sort of, either through cost saves or eating into the margin, that they will bear the brunt of the cost. I'm sure not all retailers, though, are positioned to do that.
Yeah, we do like Walmart because 2/3 of their business is domestically sourced. Because keep in mind, about 55% of Walmart is grocery. And Walmart is committed to everyday low prices. I was just in Arkansas. I'm wearing an EDLP pen. But what we like about Walmart is they are committed to value, and that's what customers want. There will be some combination. Walmart did guide gross margins down, so they will be taking some of that cost pain away from the consumer to continue to offer a strong value. But our stock picks in terms of this environment include Walmart, Kohl's, and Ulta for different reasons. But one major reason is we think the U.S. consumer is very strong.
Oliver, I remember when the markets were stressed out, we talked about the fact that multi-line retail, U.S.-based multi-line retailers were the outperformers during that market downturn. We're talking about names, like you said, Kohl's, also Nordstrom is one of them, Dollar Tree, those types of names. Take us through the reasoning why you think they would outperform in a market that's been stressed out the way it has been over the past couple of weeks here.
Yeah, what I think investors appreciate is dividend yields as well as free cash flow yields. At Walmart, you get a 3% dividend yield, a 7% free cash flow yield. And what we see overall in terms of the retail environment is the big getting bigger in terms of large retailers having more scale. And then the retailers you mentioned are defensive opportunities that cover a broad range of products. That's another great quality, too, in terms of owning stability in a time of change. So that is definitely a characteristic, and the free cash flow yields, as well as being a broadline retailer and a safer haven, are nice positives. Also, what we like is these domestic stocks as well, given our conviction that the U.S. consumer is in a good place, and we will have a good holiday in our view.
One of the bigs is getting smaller, and that would be Sears. I don't know whether you cover it, but I know you must think about it and have some observations about what is likely to happen there. So talk to me a little bit about Sears and who the beneficiaries of its shrinkage or maybe demise could be.
Yeah, and in our analysis that we do at Cowan, we see the greatest overlap at Target and Walmart. Also, department stores such as JCPenney, Kohl's, and Macy's will benefit too. There's 70 to 80% plus overlap or more with Target, Walmart, and department stores overlap about 55%. So they all stand to benefit. What we like in particular is Kohl's. Kohl's may see a 1 to 2 point comp store sales benefit from the closures of Sears. But as Sears goes through a liquidation process, that will be pretty competitive in terms of promotions in the beginning, but this will free up dollars for other retailers to really compete hard for these dollars, whether it be in apparel or hard lines. But it's an opportunity in terms of what's happening, although Sears was an iconic brand, and I'm sad about it too.